A warm welcome, everyone, to this webinar with the weight and general index. It's very nice to see that we have so many people signing up to this webinar called "The Price is Right: Decoding Marine Fuel Prices in Transition." I'll start with a little introduction first before we bring in Nakul Hirani and Thomas Horsik that is with us today. Nakul is from GX. GX is or general index. Daily energy prices are calculated algorithmically based on thousands of trades collated over 200 data markers using a consistent methodology and a compliant approach. They produce over 4,000 daily prices in crude oil, refined products, LPG, marine fuels, and energy transition markets. And they pride themselves on being the most customer-centric pricing provider in the industry. So we look forward to hearing more from Nakul later on. Weight, I'm from Weight, I'm Frank Mellum. I'm mainly focusing on shipping emissions, and I'm both part of the carbon team and the renewable fuels team. Weight is a leading provider on data-driven insights to low carbon markets. We cover renewable power, renewable fuels, and carbon markets with unparalleled breadth and depth, backed by experts in independent objective research and analysis. Our team of analysts cover market developments on every continent, strengthening clients' decisions through analytics and market intelligence. Before we'll start, I can briefly introduce the two panelists. It's Nakul. Nakul primarily focuses on the biofuel and marine sectors in general index. He sits on the index team, which is the division that is responsible for index methodology and development. Understanding changes in biofuels and maritime policies ensures that prices produced by general index are kept relevant and useful to industry stakeholders. Nakul has been with the general index for 3.5 years, and with a background in mechanical engineering, he has helped build refinery models and other robust methodology. Thomas in Weight is responsible for in the renewable fuels team and focuses on the development of analytics and insights about alternative transport fuels. He's leading our analysis and product development efforts, ensuring that we cater to adaptly to the evolving needs of transportation system moving away from fossil fuels. He previously worked in DNV and was instrumental in shaping strategic insights he now provides, helping our customers navigate the complexities of the energy transition in the transport sector. Okay, so that's the formalities. Before I bring those two guys into the conversation, I thought I'd just give you a little bit of the regulatory overview that is the background for the prices that we are discussing. I'll do this very quickly. I mentioned that that Weight is in renewable power, renewable fuels, and in carbon. So what we see now is a patchwork of greenhouse gas measures. It's both global through the IMO, it's regional through EU, but we also have national regulations, like we have in Norway, for instance, with the CO2 tax. The IMO's net zero framework is the new kid on the block and add to all the other maritime regulations. Now there are provisions in the EU regulation that say that they will make a report and may produce some additional legislation or change legislation once the IMO adopts its new net zero framework. But as for now, we'll just look at what happens if we include all these regulations on top of each other. What we can say for sure is that all these regulations provide the financial incentive for all emission reduction activities. But as I mentioned, it's a dynamic regulatory landscape. Yeah. And so what happened last year was that the maritime sector was included into the EU ETS. It has been a gradual increase. I think it's more or less the same scope as fuel and maritime. It covers ships about 5,000 gross tons. But the EU ETS covers all emissions, so you have to pay for all the CO2 that you emit, or CO2 equivalents, and it's gradually phased in. So now we're in 2025, and it's 70% coverage, and it will increase to 100% next year. So the EU ETS is a little bit different than the fuel and maritime and the IMO, that is a greenhouse gas intensity based regulation. So this starts, the fuel and maritime started, of course, in 2025. This graph starts from 2028 to compare it with the IMO later on. But as you can see, it's stepwise down for every 5th year. And the targets are quite relaxed for the first few years. The EU has their target compared to 2020 emissions, and it's a 2% decrease, which then gradually increases to -6%, -14%, and then -31%. So the alternative fuels are not really needed maybe before 2035, 2040 to comply with the fuel and maritime for all ships. The IMO has a more gradual introduction, year by year, starts in 2028. We only have targets up to 2035, but then we have some knowledge about how they should end up in 2040, so we have extrapolated down to them here with the dotted line. It has a baseline from 2008, so a slightly higher baseline than the fuel and maritime. If you put them on top of each other, we see that in terms of ambition, it looks like the IMO net zero framework is slightly more aggressive than more aggressive than the fuel and maritime, but it doesn't tell you the full picture, as the penalty of not compliance is higher in fuel EU as it stands now, whereas the IMO network framework has a two-tiered approach. So if you look at how credits are traded in or generated and paid for in IMO, then I put in an example ship here that has the blue line, which has a vessel that has emissions declining by 1% per year, starting around 70 grams per megajoule, which is quite an efficient, or have a fuel blend or of some kind. So in the first years, maybe here from 2028 to 2031, you can see they generate these called surplus units that they can either bank for later, or a couple of years, or 2 years, or they can sell it to someone else. Around 2031, for our example vessel, we see that emissions come above the direct compliance target, which is the tier 1 lower target. And then in that bracket, vessels have to pay $100 per ton that is emitted. And then when emissions come above the base target, then they have to pay $380 as it stands today. This fees or for remedial units will be adjusted later on, or could be adjusted. So we just made one simple calculation to show you how this will play out for a typical journey. So we've looked at a 3,000 TEU container ship on a 1,800 nautical mile voyage, and we've specified it for intra-EU sailing, EU to non-EU, and outside the EU. And as you can see, the bunker cost, the black one here, is stable. And then if you're inside the EU, then you get a more than doubling because of the EUA cost and some additional fuel EU and IMO cost. Now, this is assuming that all costs are put on top of each other. If you use Wait's forecast for EUA prices, we get this picture for 2033. Remember now that the fuel EU has kind of come into its second phase, passed by the or has one more step down on the ladder, or steps, if you like. And now you can see, with additional EU cost and IMO cost, the bunker price, or the total cost of bunker and GHG cost, will be 3 times as high as just the bunker cost. And for journeys from the EU to outside the EU, it will more than double. And also for the just voyages outside the EU, will have a significant increase in cost just from the tier 2 remedial unit costs. Okay, that was a pretty long introduction. I'll come back to the panelists, and I think I'll start by bringing Thomas into the loop. So now that we looked at the regulations that I presented, the EU ones are still quite recent, from 2024, 2025, and the IMO is still not adopted. But do we already see any behavioral changes from shipping companies?
Yeah, thanks for the question, Frank. I think it's fair to say that we already see some changes in the maritime fleet, and I would like to use the portal that we use in White to show you how it looks like and tell you a little bit more about the changes that we can see already. And Frank, let me start with the current fleet and operation, what we can see there already. And here you can see a graph. We have different vessel categories organized by type of fuel and vessel count. So it's the number of vessels. We can also later look into gross tonnage if we want. But what we see already is that still, of course, a large majority of the current fleet is operating on conventional fuel, right? So 80 to 85% is heavy fuel oil and very low sulfur fuel oil, and the rest is marine gas oil and LNG. But grouping them into conventional, we see, as I said, large majority conventional fuel. The second largest group is then LNG. But we already see today about 55 vessels running on methanol. And that doesn't have to be renewable methanol. It's just the fuel that they're capable of using. About 1 ammonia ship operating, and some unknowns which might distribute over the other categories. So I would say, yes, we see.
So we can still see a couple of ammonia and methanol ships coming into even if the fuel and maritime is pretty relaxed in the first few years.
Absolutely. And those are especially first movers, we would say, as you have elaborated a bit earlier. It's not needed yet, and it's also not needed in the coming years to use already ammonia and methanol to just be compliant. But of course, if you want to be a first mover, if you want to be first in securing the fuel, it could make sense. But let me also look into the order book, because I think this is something, the order book in specific, where you can see a bigger change compared to the fleet. We can start looking at the different types of alternative fuels. And alternative fuels, usually you would have LNG also grouped into that group, alternative fuels. But I leave it out here for now. So we are looking at hydrogen, methanol, and ammonia at the moment for different ship categories again. And we see that for this year, we can expect about 50 ships in different sectors or different vessel categories. The strongest ones we see here in the container ship segment, which is a segment that is very keen and goes forward quite a lot with ordering vessels fueled by alternative fuels. Mm. If we look into next year.
So just for a question on this one, this is vessel that comes on the water in this year's, or are they ordered in that year?
Exactly. They are in the order book already, which means they are going to be produced and will be delivered in that specific year that you can see here below that bar. And when you look at the vessel categories that are going forward in terms of order book for alternative fuels, it's the container ship segment and the car carrier segment. It's quite interesting if you look at the bulk carrier segment. Then you can see that also here you will see ammonia, methanol vessels being ordered, and same as ammonia vessels. Why is that? Because the bulk carriers, they're usually very big ships. So in the current fleet, you can see about more than 13,000 ships that have more than 5,000 deadweight tons. And also those bulk carriers, they operate usually on a tramp trading pattern. So that makes it much more complicated to foresee where they are going to bunker next. Whereas categories like container ships or car carriers, they usually trade on the same route, and here it will make the decision easier to decide for an alternative fuel because you know the bunkering locations.
Yeah.
And last, let me close this by looking into hydrogen, which is a fuel that is very often talked about, but now has seen some, let's say, it has been put into the shelf, some projects in Europe. So here the order book looks very small. We see about 6 ships now in the order book, and those are in the passenger and container ship segment. So vessels operating on pure hydrogen, very, very few. Ammonia and methanol currently dominating each in their category, the order book for alternative fuels.
Thank you, Thomas. I think before, as you close your presentation, I think before I bring in Nakul, I just remembered to tell you guys that we're recording this session. So if there is a lot of numbers like Thomas presented now, there will be a recording that you can look at afterwards. And if you have any questions, you can post them in the webinar chat, and we'll try to address as many of them as possible. And if you don't have time, we'll come back to you afterwards. Please put in your name so that we can see who we are answering. But okay, then we'll continue with Nakul. And first, for anyone that is unfamiliar with your work, could you provide a little bit of background on GX and what's GX role in this energy transition or fuel transition?
Yeah, thanks, Frank. Very pleased to be here, and hello to everyone who's tuned in. So General Index is a price benchmarking company, only 5 years old, so we're relatively new in the space, but we are doing things in a different way. So we're trying to use technology, we're trying to use automation to advantage in the sense that there's less subjectivity and there's more transparency about how prices are actually created and calculated. So benchmarks are important just because they allow price transparency and also allow people to start trading, whether it's SAF, whether it's biobunkers, LNG, hydrogen, a little bit more freely in the space. So General Index is FCA authorized and it follows IOSCO principles. And the idea we have is methodology is mathematical steps. So mathematical steps can then be codified, it can be automated. And again, that means less subjectivity, less room for kind of market manipulation. Now, we started with crude and refined products when we started this journey 5 years ago. And I think the best way to showcase this is showing our kind of new platform called GXGo. So on GXGo, we have all our prices. There's roughly, I think there's 4,164 as of this morning. And it gradually increases as the day goes on, as we create more and more indexes. So as you can see on the screen, we have the kind of refined products side of things on the market screen, sorry, and then broken down into marine aviation, biofuels, and so forth. So the screen that we can see here is the marine fuels screen. So we're typically talking about fossil marine fuels. So General Index's offering is around 850 daily port grade combinations covering 500 ports globally. So these ports include the likes of Singapore, Rotterdam, Houston, as well as some kind of quite niche ports all around the world. The topic of this conversation is the future marine fuel side of things. So as you can expect, we won't have 850 price but port grade combinations for these particular products, but it is a growing market, and this is something that we're continuing to build on. And there's more and more ports out offering these products as well. And then the final part is the traditional wholesale fuel oil price as well. So I just wanted to flip over to the biofuels and transition side of things here. So on this page, we have the key products across all the different all the different regions, starting with the US. So things like ethanol, biodiesel, renewable diesel, which are all pivotal to the maritime industry as well, as more and more people are starting to blend these products with fuel oil and also starting to use them as outright fuels as well. So we have the European side of things here with some Europe feedstocks and some Asian products as well. Now, one thing I wanted to kind of quickly just mention is the fact that methodology in terms of price calculation is incredibly important, because if there's a robust benchmark, that's what convinces people to start actually trading products and trading on a particular benchmark. So for all indexes that we produce and shown on GXGo, we have a fact sheet. So we're just going to open up, in fact, let me open up renewable diesel. That's a little bit more utilized in the maritime space. Let me just do a quick refresh.
Yeah, it's loading. There.
Yeah. Well, there we go. Having a few internet issues today. So let's scroll down to, let's say Udemy. And then we open up a fact sheet. And then in this fact sheet, this gives a little bit more information about the things like frequency, pricing basis, and so forth, as well as history, quality spec, criteria, and approach. Now, the most important thing I think in this fact sheet is the flowchart. So this shows the key decisions that are used to create these particular indexes. So you can often download this fact sheet and you can see the related code, such as the parent index. For this case is Udemy versus LSGO. So benchmarks are coming about in these new products. However, it takes some time in terms of contributing data. Sometimes transparency is seen as a negative thing to some market participants, but as markets grow, as we've seen for sustainable aviation fuel and renewable diesel, it becomes a more and more needed thing or needed product to actually start to trade these products on a global basis.
Thank you, Nakul. I think now that we've seen a little bit like where we can find it in your portal, and it would be nice to perhaps have a little bit more like background on how are these prices going to develop. I think that's what people are a lot of people are wondering about, right? How do can you see like where biofuels are going now that we have all this tariff stuff changing every day? Can you see that in live prices, or is that too sensitive to show that?
Yep. Well, what's going to happen in the next 5-10 years is a $1 million question. As we've seen in the last couple of months, it's been quite up and down. We've seen some kind of big changes in terms of product flows as well. And one of the things I wanted to mention is the tariffs between the US and China was reduced significantly yesterday. However, what we did see is flows of used cooking oil that typically comes from Southeast Asia, particularly China, had completely dried up going to the US. So there was a lot of thought about where this used cooking oil would go. And the idea was it would come straight into Northwest Europe, where there's SAF and renewable diesel production as well. However, there was other complications where there was rumored to be the ISCC being investigated by the EU Commission over what's classed as used or what's classed as a waste product versus what's virgin palm oil. And one of the things that it's complicated in terms of these waste products, such as used cooking oil, tallow, palm oil, and malefolent, is there's 3 different sectors that are fighting for this feedstock. Right, you've got the aviation side, which then produces used cooking, goes into the production of SAF. You've got the road industry, where again renewable diesel, tallow, POMI is going into the production of renewable diesel. And then we've got the maritime stuff as well, where this then going into these bio bunker and bio blended side of things. So it is a tricky situation. And I think what the IMO announcement has done recently is actually potentially we're going to leapfrog the likes of the bio blended stuff and move straight into e-methanol and bio ammonia as well. Is obviously a transition, but potentially that might help out in terms of understanding where the product will come from.
Interesting. Do you guys see a difference in who the interest is coming from? Is it changing from aviation and road to maritime, or has maritime always been interested?
So I think we've seen a big uptick in the aviation side of things, purely down to the reason of the SAF mandate kicked in earlier this year, so at the start of 2025. So this mandates 2% of SAF to be lifted from EU airports. So because of this, we've seen a massive upsell in the interest in SAF. However, this has brought the prices down, and refinery margins have tightened quite a bit. And on the marine side of things, I think it's always been on the the back of people's minds. But now with this IMO announcement, I think there'll be a real big push to starting testing B100 blends, B24, B30 blends as we go through this year.
I guess also it's a short-term thing and a long-term thing. And now I guess the biofuel, the forward curves are being developed, and you can kind of get the new data in there, but probably will take a little bit of time before that's as mature as many of the others benchmarks.
That's right, exactly. With benchmarks, it's all about having data. And at the moment, we're gathering data for spot prices. However, we're starting to build prices that go out into kind of 6 months, a year ahead. So typical forward curves generally are 1 or 2 years going forward. However, the data needs to be there in terms of bids and offers that are used to build this curve. And I think the best proxy at this moment in time is actually using fuel oil forward curve. So on the screen here, you can see a forward curve for 0.5% Northwest Europe barges. And you can see compared to last year, we're seeing a much shallower curve. So last year, the curve was in quite a strong backwardation. We still see that backwardated structure, but then it flattens and slightly turns into a contango effect at the back end of the curve. So it's a good indicator of understanding where marine demand or fuel oil demand will go. And I think that's a very good proxy to understanding where the likes of these bio-blended or methanol or ammonia demand will go in the next 2 years.
Interesting. I think we could spend more time on this, but I think I'll in the interest of time, I think I'll bring Thomas back into the loop. Seeing all these prices and looking at the fleet in operation, I guess for those who also need a longer term perspective, you talked a little bit about the order book, but also in terms of fuels and blends, and what do you expect, Thomas?
Yeah, no, that is a very valid question, Frank. And here I think this what we have developed in White is the so-called fuel monitor, which I'm just sharing right now, which you can see, and I will dive into this a bit more. But let me explain what it is. I think it's not a competition to what has Nakul just shown what GX is doing, whereas GX is very interesting data, I think, for the current fleet in operation. But if you look into the vessel order book, those are orders for vessels. Vessels usually last 15 to 20 years. It's really long-lasting assets. So if you order a vessel today, you would really like to know how are the fuel costs going to develop in the next 5, 10, or even 15 years. So therefore, we set up this fuel monitor based on a techno-economic model. And here we have included all different fuels that are currently under discussion in maritime, ranging from biodiesel to bio-LNG, biomethanol, so the different biofuels, e-diesel, e-methane, which are not so much talked about today, but of course we also have renewable methanol, green ammonia, and then different biofuel blends. And just as an example to show you what it is, I've put up here a comparison of VLSFO, fossil LNG, and the most popular blend today, I would say, probably B30 blend. We have different regions that we cover, but let's stick with Northwest Europe. And this is by UST per ton, but we could also compare it on an energetic value. And those are production costs. Yeah? So this model shows pure production costs. There's no margin on top of it, pure production cost, which is still a good proxy to give you an idea, how prices are developed. And you will see that LNG costs in Northwest Europe are going to drop in the next 5 years. That's our expectation. And then flattening out over the horizon to 2050. Whereas VLSFO is on a steep, or maybe not steep, but continuous increase. And so is B30 blend, which of course includes a share of fossil fuel as well. And one thing Lakul has mentioned, and that you might wonder when you see those prices, is competition. And competition here is already factored into those curves, or the data that you see here. So the rising competition in aviation, just because the sector has higher margins and a higher willingness to pay, or ableness to pay, if you want to say, compared to maritime. We will see a strong competition for biofuels. Not today. There's currently, let's say, enough advanced biofuel out there to supply both. But in the coming years, we will see a strong competition, and then you will see that B30 blend is also going up in production costs and prices in the long run.
Thank you, Thomas. I think that's interesting view on how we see the world will or the prices of these fuels will go over the next, or in a really long term. Yeah. But I think for Nakul, seeing Thomas's lines here, what do we know actually about the prices of alternative fuels now for methanol, ammonia, hydrogen?
Yeah, it's a, like I said, a growing market, particularly the methanol and ammonia side of things. As Thomas said earlier, hydrogen is one of those products that has a lot of potential, and I think there's a lot of work going into understanding the safety aspect of it and how it can actually be used in the maritime industry. But with these kind of B24, B30 LNG and methanol prices, it's all about understanding where the data is coming from and who's actually trading the product. And for these illiquid markets, generally how it starts out is people have their indicative prices, so their indications, and then on board starts to come bids, offers, and trades. So what we do at General Index is we do things in a priority order. So we prioritize bids, offers, and trades to come up with an index. If on a particular day, like these fuels won't trade on a daily basis, particularly in some ports, we then fall back on indications as well. So we have a hierarchy, and that's something that is built into the methodology. And the way we look at it is there's truth in terms of the trades and the bids and offers. So that's what we prioritize to start with. But one of the things that we're starting to move into is
it's a mix
things like,
of what you get of information and then of orders, and then you combine that with the methodology to get the benchmarks. Exactly,
that's right. Yeah, so we prioritize bids, offers, and trades if they are received on a particular day. And one thing that we've tried to do for newer products or newer markets such as e-methanol is understanding where the production is highest. So if we're using e-methanol as an example, we have China, who's the leading producers of e-methanol. So we then are able to come up with production cost estimates for those particular plants in China as well. And the way the reason we do that is because it provides some level of clarity. In a rather opaque market, it provides a little bit of transparency, understanding what the production cost is, and then people can then add on green premiums and green margins to figure out a spot price as well. But it helps direct people's decisions in terms of where they focus their trade on next, and where they focus also the next steps in terms of company-wide as well.
Thank you. I think like for this transition to happen, I guess like either the fossil fuels have to be more expensive, or the alternative has to become more or cheaper. And I think the price gap between the two must be lower. What do we know of this, and what do we expect? I don't know, maybe Nakul or Thomas, do you want to elaborate?
Yeah, I can do that, and I would just go back to our fuel monitor, because not only does it include bioblends or biofuels, but I can start with that. We see, for example, bio-LNG, which is also a promising fuel to reduce emissions for the growing share of LNG vessels, which we have seen a bit earlier in this webinar, in the order book, but also in the fleet in operation. So here we will see, that's quite interesting, bio-LNG being actually on level with fossil LNG in the late 2030s, or let's say around 2040. But you asked about the other fuels, because if you look at biofuels, they are very promising, and you have shown that earlier, Frank, to be compliant. You can use biofuels in the next decade and probably even further. But
yeah, and also I was thinking of when the bunker fuel will be on parity more or less with the new fuels, and
yeah,
like you see here, the green line for VLSFO crosses bio LNG around late 2040.
As well, exactly. What I wanted to elaborate is that biofuels can help you now, and there will be also cases in 10, 15 years. But I think if you really talk about scalability and deep decarbonization of the maritime sector, you need hydrogen-based fuels, so renewable methanol and renewable ammonia. And this we also have here. A price forecast for, or fuel costs, or not price forecast, a fuel cost development forecast for green ammonia. And that looks quite promising, that in 2030 green ammonia is on level with VLSFO, and also even a bit earlier with fossil LNG. But this is because the unit here is USD per tons, which is interesting. Of course, if you are about to procure green ammonia, you would like to know the cost per tons. But of course, as an operator, you would need to know the costs per energetic value, because that of course differs between fossil fuels and so-called new fuels or low carbon fuels. And if you change to USD per gigajoule, also here again in Northwest Europe, you will see that it will take up to the late 2040s until those fuels reach cost parity. So in order to make those fuels attractive, we need what you mentioned earlier, Frank, and that is regulation and policy, that is just making the competition a bit fairer and putting a price on emissions. And then the cost parity will come much earlier if you put those penalties or non-compliant penalties on fossil fuels.
I think this is a very long-term picture that you're showing, Thomas. Sure. If I see graphs like this, I think my initial question would be like, how much uncertainty is it, and what's the most uncertain part of a long-term analysis like this?
Sure. No, that's fair to say. I mean, there's of course uncertainty in it. At least we update those graphs and the numbers behind that model every quarter with our in-house models that we run. That gives us input on electricity costs, natural gas costs, prices, and so on. So this is updated frequently. That's, I would say, at least one advantage. And we also react on global policies. And I think this is probably the biggest uncertainty. So if you have a scheme such as the FuelEU Maritime, the new IMO scheme, but also Refuel EU for aviation is important, because the more of a product you produce, the lower the costs get. So in this way, competition could actually be an advantage. If you have multiple sectors producing or demanding a similar fuel, that will bring down costs for everyone, so to speak. So I would say the biggest uncertainty is, of course, the regulatory landscape. If things get loose on the side of IMO or FuelEU Maritime or the EU ETS, that will change the picture, and you will not see the investment into new fuels, and that will just hinder the decrease of costs. So you need to deploy a technology in order to reduce its cost.
And if I understand correctly, also is it the correct interpretation to say that it's 2045 around on this graph, but what we think is that at some point the lines will cross, and it's not necessarily we update the models so that they will cross, but which year kind of changes depending on the updates.
Yes, it's not changing significantly, so it's not changing by 5 or 10 years. That's obviously the advantage of long-term forecasts. If they are built robust, that will not change significantly, even if let's say the EU ETS price is not 200 but 210 euros per ton. That doesn't change the long-term forecast a lot, because this is economies of scale, deployment of technologies, learning rates, and so on, that more or less are predicting this in the long term.
I think so. Now we looked a lot on the demand side, and of course this is like a chicken and egg problem. Like everyone wants fuels, and who can produce them at the right time. So I think this can go to both of you. What do we know about the supply side? What is the supply side ready to produce these fuels, or is it more needed there as well? I don't know, Thomas, do you want to start, or?
Yes, I can start if you want. Then let me just quickly share the screen again. And we have our tool called the Fuel Supply Analytics. Let me just expand this tab. It just shows all the different content that we have, but I would like to increase the view of the map a little bit more. So this is our Fuel Supply Analytics, and it's brand new. So there will be a lot of additions coming in the next months until the end of the year. But what we see so far is, let's stick again with biofuels. We have discussed biofuels a lot. You can see production sites for renewable diesel. Those are the pink ones, and biodiesel in the light green. It just shows you that biodiesel production is very heavy in North America, whereas renewable diesel is more spread in North America and Europe, and some upcoming production also in Asia. And what you can see here is all the projects. So we have gathered multiple databases and updated this data frequently, and you can see what is also expected. So you can see current production within 2025, but also upcoming production in terms of projected projects that are expected to come online. Not all of them will come online. That is also part of the truth, but at least it gives you an indicator of what is expected. And on top of this, we can also look into the hydrogen-based fuels, so ammonia and methanol. And there you will see that the forecasted projection is heavily dominated by ammonia. And then you can also see that the production sites, they are really spread across the world. You see production coming up in Australia, in Asia, Northern Europe, of course, Northwest Europe, but also the US and Latin America.
While looking at the map, Nakul, do you also have, how do you get prices from all these different geographies? Do you have availability on prices on that?
So for these newer fuels, like Thomas said, a lot of these plants are yet to kind of become online. So once they do become online, that's when the market starts to actively trade the product. And one thing I kind of want to take it full circle, actually. We started talking about Donald Trump. We're probably going to end off talking about Donald Trump. In terms of the Inflation Reduction Act in the US, I think at the moment it's very unclear on how you can get these 45Z and 45V tax credits back from the production, these production credits. And I think a lot of the producers within the US have been waiting for clarity on this. And once this clarity does come in whatever form it does, I think, to Thomas, your map will change drastically in terms of more and more people will start producing these products, and such as hydrogen and such as kind of renewable diesel, biodiesel. And I think that will help push this energy transition along further as well. And I really do believe that this is an important pivotal moment in the energy industry at the moment, where we're hoping to start to transition into something that's green and something that's more sustainable as well. And with the government help from whichever governments that we're looking at, I think it will help push it along, and people will start to produce these fuels and also start to use these fuels and understand the importance of them.
Thank you. I also keep an eye on the chat there. I see we have a couple of questions. We'll try to get into them in a minute. I think before we wrap up, the discussion first. Anything you want to add on the supply side?
So one thing I wanted to add in terms of, again, Thomas touched upon this a little bit earlier, is the hydrogen-based fuels, if you look at ammonia and methanol as well. And to an extent, so is renewable diesel. Renewable diesel, in terms of production, you need hydrocracking, which uses a lot of hydrogen. And at the moment, this hydrogen is grey hydrogen that's being used in the production of renewable diesel and sustainable aviation fuel. However, more and more people are going to start understanding, right, where's this hydrogen coming from? And is it green hydrogen? And that's where I think the likes of the Middle East will come into be a big player. We've seen in Saudi the NEOM hydrogen facilities that are promised to be up and running in the next, I think, 5 to 10 years at least. And green hydrogen is a pivotal product to then enable other products to be produced as well. So yeah, just wanted to add on that point where it's down to where there is a good availability of green hydrogen.
Yeah, I think to wrap it up, I think it's like you mentioned, Nicole. In a way, it's like a tug of war between the two camps. It's one of them saying that alternative fuel prices is always too pricey, and they will always be too pricey. And then maybe that we're not seeing the cost reduction that many promised. And on the other side, you have the camp saying that alternative fuel prices need to come down in one way or the other to bridge the gap to fossil fuels, either with taxes, subsidies, or just changes in the production cost. So we've had a look into the regulations. Thomas has given us some insight to the fleet transition, and Nakul has been helpful in shedding some light on prices and how prices are the benchmarks and how they will develop. So we have a couple of questions that has come in. I'm not sure if we're able to answer them off the cuff, but we can try. There is one here. When an index is accompanied by red, it means that this price includes also certificate value, proof of sustainability, necessarily for red compliance. I don't know, Nakul, can you
Yeah. A simple answer is yes. So proof of sustainability is incredibly important for a piece of trade data, whether that's bid or offer or trade, to be included into our price as well. I think this goes back to something I said a little bit earlier, where understanding if the product that is being traded and being included into index is actually sustainable and is actually, for example, if we're going to go down the used cooking oil route, is actually used rather than virgin palm oil. So proof of sustainability is incredibly important, and I think that's what the uncertainty that's been thrown up in the last couple of months around that is very important, and something that needs to be resolved very quickly.
Yeah, and I guess also the risk for companies to be associated with fuels that don't have it is a big risk. Yeah,
exactly.
Yeah, and Thomas, maybe you can shed some light on the other one. Could you talk a little bit about the regulatory status of biomethane and e-methane regarding injecting it into the national gas grid and bunkering vessels?
Yes, I can try. I mean, with e-methane, I have not been in touch that much, so that's a bit more complicated. But with biomethane, which was part of my research activity many years ago, but biomethane is currently very promising, because in the past, and I can speak here maybe from the European perspective a bit, because that's the market I know best in terms of biomethane. It has been used for injection into the grid, and here you had different regulatory aspects, like you needed to meet a certain methane content so that it matches the methane content in your local grid. For example, in Germany, you have 2 main gas grids that have a different methane level. So depending on where you in which grid you wanted to inject, you needed a certain methane content. This I know. But anyway, it was used a lot for power and heat production. That was used to ramp up the market, so to speak. Now having a quite lively biomethane market in Europe, but this is going to end. This is quite clear because you have such a strong cost reduction for solar PV and wind in terms of power production, and also for heat, there are cheaper alternatives. So now the biomethane industry is actually looking into a new market, and maritime seems to be very promising because you can add a liquefaction unit. That's one way. You can add a liquefaction unit to your on-site, to your local production site, and produce bio-LNG. And of course, if your production site is close to the coast, it's the best, yeah, because then you can offer this bio-LNG as a fuel for energy-fueled vessels. And here it's a drop-in fuel. You can just use it as it is. On the other hand, another promising option is that you have fossil liquefaction sites, but they buy the credits from your unit and claim it as bio-LNG and sell it as bio-LNG. So these two revenue streams are now very promising for biomethane. And if you produce that biomethane from waste and not from food crops, for example, you can use it as bio-LNG in maritime and get the greenhouse gas emission intensity reduced according to what you have shown earlier, Frank, the level that is getting tighter and tighter over the years, and bio-LNG will help you to achieve that.
Very thorough answer there. I think we'll leave it to
sorry,
that. No, it's fine. We still have a couple of minutes. It's fine. I think if we're talking about the regulatory part and mass balance, we're happy to come back to that later as well on an email. I think to wrap it up, if I'm allowed to have one question to each, more of looking into the glass ball, Nakul. How do you see renewable prices going forward in the? I mean, I know that you are doing benchmarks and looking primarily at today's prices, but if you would, how do you think the prices will develop in the next decade or so?
Yeah, yeah, that's a good question. In terms of it's a big change relatively big change between pricing fossil fuels versus pricing renewable fuels. So I think, well, we've mentioned bioammonia, e-methanol. They'll slightly the markets will grow, and as we've seen with renewable diesel, the market, I think a couple of years ago it was very small, and now we've got benchmarks for them. However, one thing that I think, speaking to people in the industry, they've expressed some dissatisfaction in this sense, where fossil fuels are priced as typically as dollars per metric ton, right? But when we look at the bigger picture, is what are these renewable fuels trying to achieve? And these renewable fuels are trying to achieve greenhouse gas reduction or emission reductions. So one thing that we're starting to look into is understanding if these fuels can be priced as dollars per GHG emissions or GHG emission savings, because that's where the value is, right? So if you have two lots of used cooking oil, or Ukami or whatever renewable fuel that we want to talk about, is if one has an 80% saving versus its fossil fuel comparator, and the other one has a 50% GHG saving, the one that's 80% is seen more valuable, right? Because it's doing what is getting to the point at which you want to get to faster than the 50%. So I think that's what things will start to pivot towards. Obviously, that's a big change. Asking people to completely change the way they trade is a very tricky and a long conversation to have. But I think that there's some value in understanding how renewable products are priced up.
Interesting. Almost bringing the pricing into an abatement curve for different prices. Yeah.
Exactly.
Yeah. Okay. And the last one for you as well, Thomas. I don't know. You presented a lot about the order book. How fast do you think we can see the effect of this regulatory changes and now the IMO regulations? And also, do you think there will be like pivot towards one fuel, or will we have like a set of fuels coming into the order book in the next few years?
Yeah, I think that's the big question of the maritime industry, and having assets that last, as I mentioned earlier, 15, 20, sometimes even more years. It will take time, and a good example is you see that on the electric vehicles, something people can probably relate to as well. You see very high numbers in a lot of countries for sales share, but then you look on the streets and you say, where are those EVs that I hear about in the news? But it's a sales share and similar to the order book in maritime, and it takes really time until a fleet that consists of long-lasting assets is changing its look. So it's happening. We see that in the order book, and the orders for alternative fueled vessels are growing and growing from quarter to quarter. So there is definitely a momentum, but it will take time until we see that in the fleet. And that also relates to the deployment of alternative fuels. That will just come with the growing demand that we will see in the fleet. And when you ask about one fuel, I think I'd like to refer to a bucket of flowers, what we will see in the future. So you will see more and more vessels also running on pure hydrogen or even electricity. If you have a ferry going from shore to shore, that is possible by electricity or by hydrogen. Whereas the bigger vessels, they will use a mix of methanol, ammonia, and bioblends, but also efficiency measures that helps you to reduce your actual fuel demand. Maybe some wind assisted propulsion will help you as well, and then you might be compliant just using biofuels and wind. So we will see a lot of technologies, and I think it's very interesting to follow that transition. And yeah, we try to help with the data that we provide and the analytics.
Thank you for that answer, Thomas. Thank you, Thomas, and thank you, Nakul. I think we have covered a lot of ground in this hour, and there's a lot of detail in the platforms that you have shown. So if people have any questions, please reach out to us, and we'll be happy to follow up. Thank you very much, everyone, for joining us, and we hope to see you again at a later webinar. And that concludes the webinar. Thank you.
Thank you, everyone.
Thanks all.